All right, what a response to how the market ended last week. The market finished this week really strong, relatively speaking. It finished up. How strong it was remains to be seen. So we're going to break that down in terms of the relative strength of this week's rally and what that tells us. What drove most of this rally. Have we seen this kind of move before, where we had that selling last week and then a subsequent bounce up to new 4-week high points this week? So obviously, we have seen this before, so I'm going to show you what the significance of the past precedent is, so what we can expect going into next week and into July expiration. And then we'll talk about how to trade those expectations, specifically with kind of strategies, and then we'll use, for our trade ID, an example of one of those strategies here. So let's go ahead and get started. Today is Friday, June the 25th, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's take a look at the S&P 500 with the market forecast indicator here. As you can see, we finished a great week, 4 out of 5 up days on the week, finishing at a new high, new closing high, new intraday high, new highs across the board, all but the momentum line up here in the upper reversal zone. The strong bullish posture on the intermediate line. The near-term run is showing a strong little run here. The momentum line still down and kind of its own bearish territory, but again, I think that's more of a function of the small ranges. I mean, keep in mind that we're gapping up, so it's not exactly this small when you account for the gap, but still, like on an intraday basis, during the most amount of volume that's trading during a day, during a regular trading session, because there's very, very light volume overnight in the extended hours trading sessions. We're not getting very much of a range the last 3 days. Most of the move the last 2 days, most of the move has occurred overnight. Overnight here. So when you consider that, we've rallied from a close of 42.41 up to 42.80, so it's about 40 points. But the close here is 10 points, and the open the close there is 6 points. So out of 41 points, only 16 in the last 2 days have occurred during the session, which more of the gains occurred outside of the session, the regular trading session, where again, not very much volume anyway from a relative standpoint during the regular trading session, but it still is far greater than what you get in the extended hours. Not even close, right? Like it's very, very, very minimal. But that's where most of the gains have been occurring, is during that really, really minimal trading volume. But alas, it's produced a strong bullish posture. It's produced a strong long-term market sentiment. It's produced a strong near-term run from this near-term low to a new near-term high, a new higher near-term high point off of this higher near-term low point that we formed here. We're going to talk more about that low point here in a minute. Let's take a look at the Dow. The Dow, who had been in its own intermediate pullback, so we had dipped below 40, unlike all the other indexes. A little dip there, that got to, I think, 39. Yeah, 39.7. A little dip there that got to 41.4. So really close to 40. But obviously, we did easily get below 40 there. So we were in an intermediate dark pink shading and red line. We didn't break the 23% lines. It was a very, very shallow pullback. But a pullback nonetheless. We are back up to now green line and light green shading. We're back in the neutral zone between 40 and 60. Not quite back above 60 yet, but the near term line did get in the upper reversal zone. Very, very good finish to the week there for the Dow, which had been the one that was struggling the most. The Nasdaq, of course, has not been struggling at all. It's got this nice little rally going here. Let's see here. I don't know where I've got it from over here. Just to kind of show that the Nasdaq did have a pullback here where nothing else did. I mean, we got more than halfway into the retracement zone. That's how much of a intermediate pullback the Nasdaq had that we haven't had anywhere else, for that matter, because none of the other indexes have even broken, has even come close to breaking the retracement zone here. Let me just get the long term and the short and the current intermediate run up to the current high point. So here's where we're at now on the current intermediate rally. If you count the same time frame as what the S&P is on. Obviously, we're just starting a new intermediate run in the Nasdaq, but the reality is this is the same time frame that the S&P has been rallying the whole time. So you can see where the 30-day moving average is just barely above the 23% retracement level. And then you look at the Russell 2000, it's really high. The 23-day moving or the 30-day moving average is very high between 0 and 23%. We haven't had a new high point since March the 15th on the Russell 2000 though, and we came close a few weeks ago before June expiration. We're coming close again. Intermediate line back up above 80 again, so easily in bullish territory. The near-term line in bullish territory too. The Nasdaq, the same thing. The Nasdaq's actually getting a bullish intermediate confirmation signal, where the intermediate line strongly bullish, the momentum line's oversold. That's typically a bullish combination on a short-term basis. It's better if the near-term line's below at least below 50, if not below 40, and that's not the case. You can see the near-term lines. We've been basically on a big long near-term rally here since that June 3rd low on the Nasdaq, and so I would be hesitate to say that, oh, here's a good short-term bullish bounce signal on the Nasdaq, considering that we are on a relatively mature near-term run here, especially with that cluster towards the end of the near-term rally. Let's take a quick look at the weekly charts for these. Here is the let's go weekly on the S&P 500. You can see the near-term line dipped below 50. Did not dip all the way, but it dipped below 50 there. The momentum line bouncing right back up to extreme high. The intermediate line, market sentiment, still very extreme. So we did get an oversold momentum line last week. We went from oversold extreme lows, boom, right back up to extreme highs, just like that on the S&P 500. If you take a look at the Dow Jones Industrial Average, we didn't quite get up to extreme highs on the momentum line. We reversed last week's candle, but the near-term line still itself is in bearish territory. The momentum line's not in oversold levels. So you can see not quite the nice reversal on this week on the Dow, since it was a little bit more bearish. The Nasdaq hasn't had that reversal. We never did hit extreme lows, and you still got a strong near-term rally there. And then the Russell 2000, we're still right around the midpoint. So the intermediate posture is strongly bullish. The momentum line bounced from extreme lows up to not extreme highs per se, but at least got into the upper reversal zone here, overbought territory. And the near-term line dipped, and is dipping below 50 and setting up potentially for, if it is a continued run up above 50, we will get to new highs on the Russell 2000 after this big long period of convergence that's brought the moving average. This is a 30-week moving average that's brought it up all the way up here, way up to the current price levels after weeks and weeks and weeks here. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. You liked our video today and you want us to do another video again on Monday. Quick way to give us feedback if you like our videos. Of course, if you don't like them, you don't have to click on anything. You don't even have to watch. But if you do like them and you want to let us know, you can do it with one click. You can even do it right now while you're watching. Quick way to give us feedback. We appreciate those that do that. Also down there, comment. What did you get out of the video today? What stood out to you? What questions or comments do you have about anything I talked about? Post those in the comment section. Reply to other people's comments as well. Follow me join our website, at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between the videos from day to day. There's my handle there, at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on our webpage here, click on some of these other things over here on the right, our Market Outlook live trade review videos. If you click on this, it takes you to our Market Outlook live page. You can watch the most current Market Outlook live here, as well as all the archives. You can see that there. This is where I review all the old trade ideas that we've done in previous market outlooks. I also post today's trade idea before the market closes. So that's where you can get to that. You can also get to it by mousing over Market Outlook up here and clicking on Live Trade Review. Here's all of our upcoming trading rooms, a few of the upcoming trading rooms, our Q&A session for premium subscribers that I do every Saturday morning. Brandon does his every Thursday morning. All of our trading rooms are accessible to all of our paid subscribers, whether you're monthly or premium. Of course, our premium subscribers get access to all of that for free, or excuse me, not for free, for cheaper than what our monthly subscribers do. They also get access to those Q&A sessions, as well as other premium tools and resources, and access to our class forums. Again, only available there for our premium subscribers. Come down here, click on that heart. It opens up a new tab. Click on that like button there. Click on this thumbs up icon, opens up another new tab. Hit this like button there too. Again, the more you do that, the more people will actually see our content, more than this the 54. There's a lot more than 54 people that follow that page. But the way Twitter and Facebook work, they only promote the content to people to engage with the page. So we try to make it really easy for you to engage with us right here, so you can always be able to see our content. All right, let's get back to the charts. Let's look at the weekly Hakinyashi candle, and again, you can see a relatively bigger range with an upper and a lower shadow this week. Small body. That's again very much a transition candle. Now that's for this week. The Hakinyashi is really low down there. Again, that's the green line. The purple line is a 3-day or 3-week smooth version of that green line. But keep in mind that we're right next to that high point. So here's where the open is going to be next week, at about 42.20 or so, and we're already trading at 42.80. So we'll have a pretty decent sized bullish candle here next week. So keep that in mind. We also, if you take a look at the 3 green arrow chart for the SPY, we're back to 3 green arrows now today with the MACD crossing over, and a little bit of an increase in volume. We got up to 58 million shares trading hands. When you take a look at the 2 lines here, you can see the MACD is moving away from zero. So diverging. Those lines are diverging away from each other. Stochastics well up above its moving average again, and back in the upper reversal zone. We are, at the point where we are potentially diverging, since we're already at higher highs, and we're not quite the higher highs on these oscillators. So keep a close eye on whether or not these divergences play out. You can see on the RSI and the CCI, not so much of a divergence where we are getting a higher high in the CCI. And the RSI is back above 60, though not quite to a new high there. So keep an eye on those. From a directional movement index, we still don't quite have a directional move yet. We're still between 20 and 30 on both of these indexes. We don't really break out until you get outside of 30 and 20, one way or the other. So 30, the positive index is above 25, but it's not above 30 yet. The negative index is not below 20 yet. So still pretty much like as much as that was pretty close to a breakout, and it wasn't quite because we didn't get above 30 on the negative, we're similar here, right? We're similar to that same kind of setup right now. The ADX is really low, so we're, again, to break out of a really sideways range, you need a good breakout signal, and we're not quite there yet. SPX is in the upper quartile of its range with a really low bandwidth, so that's a positive sign. We are flirting with the upper end of this value area, which could lead to a pretty decent breakout if it does play out. Again, remember we already are in a very extended, very mature intermediate run, so keep that in mind about breakouts, right? Here's where we are from a trend strength standpoint. Again, you're not trending, you're not in the directional move until you're above 2 and you're above 65, so we're not quite there yet. If you look at the RSI, this is an interesting thing. The RSI is above 60, it's at 62 for the S&P 500. But if you look at where the average RSI is, and again, this is not updated for today yet, still as of close yesterday, but if you look at where the average RSI is across all the S&P 500 constituents, it probably will be a little bit higher here today, but you notice we're still, we're at 47, so we're actually still below 50. Remember, the S&P itself is up above 60. 60 would be right over here where this green line is. So you can see it's really hard for the average number of stocks to get above 60. The highest this average got was in mid-April, and if you look at where the RSI for the S&P 500 got in mid-April, we were right, we got up to about 70. I mean, that's a pretty high level. The average got up to about 60 there. So here we are at 62, and the average probably yesterday we were just under 62, about 50. What were we at? 60 yesterday? We were at 60, and if you look at the average, we're at 47. So about 11-point discrepancy there. It's a pretty significant drop, especially when you consider how we've progressively gotten significantly lower. Very similar to the late January, where we got lower here and we moved up. In fact, if you take a look here if you look at the intraday chart, let's go to the 4-week chart. You can see we just barely got a new low back here a few days ago. That became the new low a few days ago, and just like that, we got a new high point here at the end of this week. So you can kind of see how that works. Pretty much setting the range here between 427 and 419. This is what it looks like in the Arun indicator. When that new low became the new low, it actually crossed over the high point, and we got this little bit of a bearish pattern. Again, mainly because we had a little selling, but this low point over here fell off the 4-week window, and the low moved up pretty sharply there, and so that became the new low, and it became on this, the high point was there, so it crossed over the high, went from the left of the high to the right of the high. Well, just like that, now it's back to the left of the high point because the high is switched over here, and you can see the green lines cross back up. We've seen this pattern before. We saw it back in late January, where the new same thing, the low point peaked, crossed over the green a couple of days after the low was actually formed. That became the new low a few days later when this low fell off the 4-week window. And then just a couple days after that, we had, boom, a new high. And that ended up being a divergent high. And you notice on the NASDAQ 100, that became our pullback, right? That preceded. So we had a little bit of a divergent high point there, right there, that preceded. There's our divergent high coming after a quasi-bearish cross. So it was quasi, in fact, that it didn't get to 100. Like, we didn't produce the new 4-week low on that day. It was a couple of days later. It's the same thing here. We didn't produce the new 4-week low on Friday. We did on the next day. That's where you got the crossover. And then a couple of days later, we get a new 4-week high point. Are we setting up a divergent high point for an actual decline? That remains to be seen. But this kind of pattern we've seen before. When we've been bullish for a while, especially when you look at like the NASDAQ 100, which has been bullish for a while here, and now we're getting that kind of bearish, at least that divergent signal. This would be kind of a divergent signal for the Arun indicator, where you get some kind of a little bit of bullishness immediately after this kind of quasi-bearish signal there. Let's take a look. We saw the range today was very minimal. 1.5 points. Keep in mind we did have a little bit of a gap, so we closed at 425.10. The low was at 425.55, so about a half of a point of a gap. So we had about 2 points of a gap and 58 million shares trading hands. Very, very small range, very minimal, very low. You can see, so no signs of a crossover yet there in terms of bearishness. We had to get back above the 1% level on the ATR, and we didn't really do that on the Dow either. We didn't get significantly above that on the Dow, and of course on the Qs, we are way, we're way down. We're at 1.15%. 1.5% is like your equivalent 1% low point there, and then on the Russell 2000, 2% is your equivalent to 1% on the S&P. So kind of like a beta. You can kind of see the differences in the beta. So you can see how really low. I mean, this is very, very small ranges, very small moves, and you see that here. We got the big down move followed by the big up move, and that wasn't a surprise. And now we're back to small green candle bars here. Very small moves, very small ranges. In fact, the VIX finished the day pretty much at an extreme low point. We dipped a smidgen to 15, flirted with getting below 15 there, finished right around the 80% mark. So pretty much extremely oversold on volatility as it's sitting right on that 15 level, with very, very important level for the S&P. It's like the 20 level. Next stage down, the 20 level acted as a support multiple times. Now we'll see if 15 will act as a support, if it will act as a support before we finally break through. Again, for some context on what that looks like in the past when we've gone up above, you can see 20 can act as, you can see how 15 can act as a support when you've broken through there and bounce up before you finally break through and stay down. So you comes down, uses support, bounces back up, and then you finally break through and you only have the short little burst through that. So we'll see if that ends up being the case here, since we got this breakout. If we end up holding 20 a few times, if we hold 15 once or twice or whatever, before we break 15 and then start, then we have our slow grinding bullish trends with just intermediate pops up above 15, maybe above 20 that are, there's those buy the dip type signals. So to summarize that technical outlook, again, we're on what looks like a divergent leg higher, and we don't know how long divergent legs last, right? And it might end up being not divergent by the time it's done. We might actually get up to new highs on these oscillators that are that correlate to the current level of the price itself. So by the time it's all said and done, but we've seen a lot of these correlations, a lot of these divergence patterns before. Particularly on that Arun indicator. We've seen it in this type of situation before too. We've seen what happens. And again, we might diverge up until, say, like July expiration before all is said and done. And if we do, considering how already extremely low volatility is, expect the kind of moves we've had this week where most of the gains occur overnight, common gaps galore, common gaps that can be easily filled, eventually. In the relatively short term, again, not necessarily like a year from now, but in the relatively short term, these are all common gaps. They can all easily be filled. So don't put too much stock in any kind of bullish momentum, any kind of new. In fact, I saw something that posted today about a famous fund newsletter guy, fund manager type, putting out that he's bullish. And so everybody's kind of piling on that, oh, well, if he's bullish now, he's got a track record of being completely wrong, so now we're all going to be bearish. Well, it's not a bad thing to be bullish because we have been bullish. It is a bad thing to be just now turning bullish, right? We've been this market sentiment run since the March COVID lows, the current intermediate run since last Halloween's lows. We've been very, very mature, so it's not a good thing to just now be getting bullish, because the more and more people just now get bullish, as you can see with how weak the moves are and how most of the moves are overnight on very, very light volume, creating common gaps. That's not the most bullish patterns. Ideally, you want the gaps to be in the mornings to occur to the downside and then fill it in with the regular trading volume throughout the rest of the day and close at the high. Sell off some of that profits overnight on very light volume, create a common gap to the downside, fill it in. That's the ideal scenario. They keep going up with common gaps to the upside. Again, we've seen before that's a tenuous floor to be sitting on. So what do you think? Do you agree with that assessment? Do you disagree? Let me know in the comment section below, especially if you disagree, and share with what charts or indicators that you're looking at that suggest why you're either a lot more bullish than I am, or why you are just now turning bullish if that is the case, or why you're a lot more bearish than I am. That you think that it's more than just a divergence, it's more than just an exhale. We're gonna really fall off the floor here. So let me know or share that in the comment section down below. All right, now let's take a look at what's driving the price action. You can see the inflation trade, and you can see equities are really starting to make a run. Look at the Qs really making a run here over the last little bit, whereas commodities have stalled and real estate has stalled, and really from this low point right here, though they're pretty flat, but the Qs are not flat, right? They've gone from about a 5% gain, and really it's off of this June 3rd low point, from June 3rd all the way up till now. You can see the return, actually I guess you would say June 4th, the June 4th low point. So let's just go one more day here. Qs are up 6%, gapping up on the 4th and continuing that run, up 6% there. But interestingly enough, gold is down, long-term bonds are up. The dollar made a big jump high. This was the end of last week, and it's kind of held that week. So if I just look at just this week alone, so let's go to just this week here. Go back to a 5-minute chart. You'll see that small cap stocks up 4. I mean, they had a really good week, rebounding from last week. Long-term bonds really significantly down, and so pretty much a risk on week from that perspective. The Qs kind of lagged. They did okay, but they lagged behind. They really lagged behind small caps. Again, big significant rebound there, and then the dollar pulling back a little bit. So let's take a look at some of those charts that we like to look at. all the time from a different asset class standpoint. There's that dollar. So again, that's the rally the dollar made after that decline. So, is the dollar back to being bearish again? Not necessarily. Like, can we make that kind of a rally again up to that 23% retracement level of the long-term move? For sure. Like, we broke it, we'll rally up to it, and we'll probably make a run back down now to the 38% retracement. That's kind of what I expect will happen. From a TLT standpoint, remember TLT the week prior made a good breakout move. I mean, look at that breakout move there. They're above that 23% line, above this 50% retracement of a longer term move. And this week we pulled back. We pulled back to that much. We're still, we got light pink shading, but we're still easily above 60. We're still easily above a rising moving average. So that's the pullback. It's not necessarily trend changing in the pullback. Of course, gold, really oversold with that big decline, rally in the dollar the last week. There's a rally gold had, but gold is pretty much just staying here. Remember, gold can rally with a falling dollar or a rising dollar, and of course, if it rallies with a rising dollar, that's a risk-off move. If it rallies with a falling dollar, then that can be a risk-on type move where it outperforms the dollar. It might not outperform equities, but it outperforms the dollar. And so you can see it looks like a little bit of, if I were to zoom out, you can see it a little bit better. Looks like a little bit of a head and shoulders pattern, inverted head and shoulders pattern, where we hit that 23% retracement level before, came down and produced the 0% line. So that's ultimately what produced that 23% line there. We are sitting on that level again now with another oversold cluster on gold, with the opportunity that it might rally now off of the support again. Rallying with the dollar, it can rally either way. It can rally with the dollar or without the dollar. If it rallies with the dollar, then we're looking, and long-term bonds, we're looking at kind of a risk-off scenario, where if it rallies without the dollar and with equities, then it'd be a risk-on scenario, and you would see this particular chart, this ratio here, so this would be gold to SPY, you would see this ratio continue to go down. So here's what it did this week, and you can see pretty extremely low. Like the MACD is pretty low here. The RSI hit down to negative 200. This is gold versus, this is a risk on move when gold underperforms the dollars, risk off when it outperforms, SPX. You can see how extremely low it is on the RSI, again, how extremely low it was on the CCI, and then how extremely low it is on the MACD with a rising histogram now, which means that low point is, it seems like a low is forming. That's what the histogram tells us. And then you can kind of see what the long-term, if I were to zoom out a little bit here, you can see what the long-term view, just how extremely oversold it is on a long-term level. Very, very low PPO on a long, between that 50 and 200-day moving averages, suggesting that we might be forming a low point and having an opportunity where you can see other risk-off moves where gold outpaces equities. And remember, it can go up like that. This ratio chart can go up with gold itself going up versus a dollar or not, right? So that's, or gold and the dollar both going up, which you would expect that to be the case, again, during that, COVID low point here. Let's just go back to, like a 1 year chart here. And where is that? I guess I have to go back to a 2-year chart, don't I? 2-year chart. And then look at, this COVID low point. So from right around mid-February to that peak up here on March 24th. So mid-February, so let's say February the 12th up to March 24th. So if I were to come back to this chart, do an asset class comparison, and go February the 12th of 2000. So right before the COVID, right at the COVID peak to March 24th to the COVID low point. You can see it wasn't very long of a decline. We'll just do a daily chart. Whoops. It'd be February the 12th of 2020. There we go. So there's our move. There's the rise in the gold. There's the rise in the dollar. Both of them going up together. There's the rise in long-term bonds, all rallying. And I guess it was the 23rd that it actually hit the low there. So here's the 23rd. And then we can even go to an intraday chart and look at it, like, say, on an hourly chart here. So there's the decline, 33% decline from that ultimately we had a little bit of a peak there, but you can see gold and the dollar was already starting to rally. So they both ended up relatively strong, outpacing each, going up together. And then you can see bonds up 15%, and then all these equity asset classes, including real estate, all down significantly. So gold and the dollar can outpace together equities, and that's what generally happens during a risk-off move. So the question now is, when will the risk-off move start? Well, from a ratio standpoint, you can see, we're pretty extremely low as it stands right now. So there's an opportunity. I mean, look at how, like, we'll change this PPO to how far away it is below that 30-day moving average here. How far away the ratio is below that red line up here at the top, right there. And there it is. There's the PPO. So we're about 5% below. Seems to be the low point for that ratio. Now we can keep going down, but considering how where some of these other indicators are, as extreme as it is, suggests that there might not be a whole lot of downside left to this ratio, which would be a risk-on pattern if it were to continue to go to the downside here. All right, now let's look at the sector rotation, and let's just look at how the sectors performed this week. And we have an idea of how they've been performing, right? So, we have this little bounce back this week. Let's see how the bounce back looked like from a sector standpoint. Energy, financials, outpacing industrials for a while, materials for a while too. They lagged late in the week as discretionary and technology, which were lagging initially, started to outperform with communication services. So these QQQ type names kind of matching the market. Of course, your safety trades really picking up at the end of the day, these last couple of days. So if I were to just take a look at the last couple of days, the 24th and the 25th, financials really broke out, the one outlier to the upside. Everything else kind of matching the 1% return. Look at technology lagging along with materials here. Materials not doing so well. So again, and when we have a risk-off move, all these charts will all look the same, and you notice that's not quite the case here. We have really bullish charts well above the 30-day moving averages, dark green shading, dark green line, up above 80, 90 on the intermediate lines. Over here you have a 30, and you have a 30, and you have a 16, 15, 16 down here. So you've got real significant bearish pullbacks here going on in staples, utilities, and materials. Industrials and financials are also in the midst of a pullback as they're still below 40, even if it's rising with light green shading the yellow line. That's typically a bearish sign, unless we reverse the trend, of course. And then you look at energy, which is back up above 60 on its intermediate posture. Real estate still holding above 60, and healthcare also holding up strong. So they're kind of holding up strong, even if they're not necessarily pulling away like these cyclical areas are. So, again, this is this is very typical of mature bullish markets, when you have some sectors in bullish situations and other sectors not. If you recall, there was a time back in February and March where these three up here were in their own intermediate pullbacks, right? If I were to show you this chart here, look at XLK for an example, it did get red lines, but if I show you, here, let me show you on this chart. This would be the better visual here. If you look at XLK, it was in an intermediate pullback in February and March, and so and was also here in May, just briefly. XLY, same thing, obvious intermediate declines there, with the intermediate line well below 40. XLC, not quite the same. It didn't quite get down. It just kind of nipped below 40. Not, a little bit of an exhale, but not very much of one. So at that time, however, in February and March, you notice there was no intermediate pullback here, right? There was a little bit of one at the end of January on XLI, but no pullback necessarily there in February and March. Materials started to rally too. If you look at financials, just a little dip there below 40, but no intermediate pullback in February and March or in May on financials. Look at industrial or energy. We did have an intermediate pullback there in April, so in between were the NASDAQ. So you see these sectors are kind of all doing their own, even if SPX hasn't done one yet the entire time. Remember, all those sectors make up SPX. So it's just been kind of shifting, and that's a very like a common pattern of mature bullish runs. Of course, when you're in actual intermediate pullback mode, like you were in September here on the SPX, let's look at all these sectors here. XLK, look at September. I'm going to flip through all these. Look at September and October. You can see, okay, XLK was in pullback mode. XLY was in pullback mode. XLC, XLI was in pullback mode. XLF was in pullback mode with a cluster there. XLB, pullback mode. XL, F, E, B, E, did I do E? No, yeah, there's E. Ooh, I mean, it was in big time pullback mode back then. XLU was in pullback mode in September, even though a safe haven sector was still in pullback mode in September. XLP, pullback mode. XLRE, pullback mode there in September with clusters, and XLV, pullback mode. So everything was below 40 back then. That's not the case here lately. Different sectors at different times having their own intermediate pullbacks, but never all together, which is what signifies an actual intermediate pullback. And so we continue that's a sign of a mature run. And so like this sell-off we had on Friday, this sell-off over here, was this an actual pullback? No, because we didn't get, first of all, the SPX's intermediate line into bearish territory, number one. And number two, we didn't have all the sectors doing it too, right? Only we had a handful, just a handful. And that's not tradition. That's not the common pattern when you're having an actual exhale there. So that opens us up to, from a trade idea standpoint, the trades that we have been doing lately has kind of been, there's been some bullish trades like on Roku and Tesla here most recently. We've been looking at some bullish trades. You notice we haven't been aggressively bullish. They've been bull puts. I've been doing a lot of bull puts in class here this week. That's the type of strategy when you're bullish, but you're just not very convinced and you're kind of grudgingly bullish. You look at bull put spreads, or you look at iron condors with stocks that might be kind of in their own sideways mode. So for an example, AbbVie, which had been relatively bullish, made a nice little bullish run, has been about as flat as a pancake since. But it's been sticking here between 40 and 60 for quite a while. You look at its the Hakinyashi candles on the weekly chart, lots of transitions, lots of sideways, falling PPO. If you look at the 3 green arrows, here, let's look at the 2-line version of the 3 green arrows. You can see very look at all that convergence on those lines, all sticking right on top of each other. Both the MACD and stochastics right at their respective midpoints. Not very much of a movement in either one of those. Look at the RSI and the CCI. Sitting right in neutral zones, 40 and 60, 100 and negative 100 for most of the last few weeks. Look at the directional movement index, and you can see we are between 20 and 30 on both lines, right? Between 20 and 25 on both lines. So we're not getting a directional move in any situation here. The Bollinger Bandwidth has also been very minimal. We're in the middle of the bandwidth here and the lower middle, but we are still in the middle of the bandwidth. We're filling up a lot of volume at the top of the value area. So that kind of move sets us up for that kind of pattern sets us up for an iron condor spread. So what we ended up doing here is sold the low 20s on the deltas, so selling the 116, buying the 118, come over here, sell the 108, buy the 106. For a regular position size, you notice it puts us up right here for a regular position size there. Here, let me get rid of because remember this trade went through during the regular trading during the Market Outlook Live. There's our break-evens. There's our break-evens on the chart. Let me show you what it looks like here on the chart for AbbVie. I've got some resistance here at the top of the value area, some old high points up there. This is where we're at right now, right there. I've got some pretty good support below that break-even with that tremendous volume node. So as long as we stay in between those blue lines by July expiration, then that's how we make that $400 on $1,000 of risk. So that's the kind of trade, and I don't have to worry about earnings until after July expiration. I think that's a type of trade, as well as bull put spreads, that can allow us to take advantage of any kind of divergent high point we might get going into, and ultimately whenever it peaks, whether it's next week or the week after or eventually by July expiration. If we just kind of grind up, then these are the kind of trades that will still make us money while the market's still in grind mode. All right, so you've heard from me now. Now I want to hear from you. Use that link that's popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Anybody can post in that forum. That's available for even our free subscribers as well. So post any new threads with any questions or comments you have about what we covered in the video tonight. Reply to other people's threads. And let's keep this conversation going over the weekend in between videos. I will be out on Monday, so keep that in mind. Brandon will be here on Tuesday. Then I'll be back. I won't be back actually till next Thursday. I'll be doing the video on Thursday for Brandon as he's out for the July 4th weekend. So I'll cover for him. I'm out on Monday and Wednesday. He is here on Tuesday, and then I'll cover for him on Thursday before doing the video again on Friday, and then we have the holiday weekend going into next Monday. So that kind of gives you an idea of what our schedule is. And remember to hit that thumbs up icon, like our videos down below, subscribe to us on YouTube, comment on the videos. Have a great rest of your weekend, everybody, and we'll see you all next time.